On February 3rd, 2022, Meta lost more than $230 billion in market value in a single day, not over a month, not over a bad quarter, in one trading session. On every financial channel, the same image kept repeating, the Meta logo, and a red line falling off a cliff. The stock dropped about 26%, and at the time, it was the largest one-day loss of value ever recorded by a United States company. Almost immediately, everyone reached for the same explanation. Mark Zuckerberg had bet the company on the Metaverse. He was pouring billions into virtual reality. The headsets looked clumsy, the avatars looked cartoonish, and the virtual worlds looked empty. The internet had already decided the whole thing was a joke, so the story wrote itself. The Metaverse killed Facebook. It was clean, it was satisfying, and it fit everything people already believed. But it was too simple, because the most important object in this story was not a virtual reality headset. It was something most people were holding in their hand without thinking about it. An iPhone. The thing that quietly revealed the weakness inside Meta was a small question that had started appearing on millions of phone screens months earlier. A simple privacy prompt asking whether an app could track you across other apps and websites. That prompt looked harmless. To most users, it was one tap and then forgotten. But to Meta, it was the beginning of a crack in the foundation. To understand why a single line of text on a phone could help erase $230 billion, you first have to understand what Facebook actually was. Not the app, the machine underneath it. Most people think of Facebook as a social network. Photos, friends, birthdays, arguments in the comments. But that was never where the money lived. Underneath the friendly blue app was one of the most powerful advertising machines ever built. Facebook did not just sell ads, it sold certainty. Think about what that meant for a small business. Imagine you run a small online store selling handmade candles. You open Facebook Ads Manager, you put in a few $100s, and you launch a campaign. Then something close to magic happens. Facebook does not just show your ad to random people, it finds the people most likely to buy, then watches what they do next. It sees who clicked, it sees who reached the checkout, it sees who actually bought, and it feeds all of that back to you in one dashboard. For the first time in history, an ordinary business owner could spend money on advertising and watch almost in real time which ad turned into a sale. No guessing, a number, a receipt. That was the real product. Not the ad space, the confidence, but that magic depended on something fragile. To follow a user from an ad on Instagram to a purchase on a completely different website, Facebook depended on signals that helped follow that journey across apps and across the open internet. And almost none of that internet belonged to Meta. The ad lived inside Facebook, but the customer was using a phone Meta did not build, running an operating system Meta did not control, downloading apps from a store Meta did not own. For years, that did not feel like a problem. The signals flowed freely, and the dashboard felt like the truth. Until the company that did own the platform decided to change the rules. That company was Apple. In 2021, Apple rolled out a change called App Tracking Transparency. When you opened an app, you might see a small prompt. Do you want to allow this app to track you across other companies' apps and websites? Ask the app not to track, or allow. For many users, the choice was obvious. When asked plainly whether they wanted to be followed around the internet, they chose not to allow it. Apple framed it as privacy, and from the user's side, that framing made perfect sense. But step back, and you can see what really happened. Apple owned the iPhone, the operating system, the App Store, and the rules inside it. And with one update, it turned tracking from something automatic into something users had to opt into. For most people, nothing visible changed. For Meta, a part of the signal layer that powered its entire advertising machine began to go dark. And the deeper problem was not targeting, it was measurement. After Apple's change, fewer users allowed apps to follow them from one place to another. Some sales still happened, But Facebook could no longer connect every purchase back to the ad that caused it. The receipt started turning into an estimate, and Meta knew it. On the company's own earnings call, its executives said the change was creating two distinct problems. Targeting had become less accurate, and measuring results had become harder. They warned it would hit businesses of every size, but especially small ones. Then Meta's chief financial officer put a number on it. He estimated that Apple's changes would create a headwind on Meta's business that year, on the order of $10 billion. $10 billion from a platform change most users experienced as a simple privacy prompt. Now, it is important not to overstate this. Apple did not delete Facebook. App tracking transparency did not switch off Meta's ads. The machine kept running, but it ran with foggier instruments. And for a business built on certainty, fog is expensive. Apple had not destroyed Meta. It had done something far quieter and far more powerful. It had changed the rules of a platform that Meta did not own. For most people, all of this was an abstraction. But for the people who actually ran ads, it showed up on their screens. And it was strange. Imagine that candle store again. The owner opens Meta Ads Manager one morning. The campaign is running, but the conversions are lower than they should be. Some are delayed, some seem to be missing entirely. So she checks her actual store, she opens Shopify, and the orders are there. The sales are real. The money landed in the bank. 2 screens, 2 versions of reality. On one screen, the business is alive. On the other, Meta can barely see it. The sales had not vanished. What had weakened was Meta's ability to watch the journey from beginning to end. And across advertiser communities, this confusion showed up everywhere. In Reddit threads, in LinkedIn posts, in marketing discussions, the same pattern kept appearing. Advertisers were not only asking whether Meta ads still worked, they were asking something stranger. They were asking whether Meta could still see what was working. That is a very different kind of fear. Now every decision becomes a guess. Do you trust the dashboard or the bank account? The customer journey did not disappear. The ability to see it did. Now, a fair warning. These community posts are not hard proof. Not every advertiser had the same experience. The internet is always louder about pain than about calm. But the pattern was real enough that an entire industry started rebuilding the way it measured. Marketers leaned on first-party data, the information businesses collected directly from their own customers. They turned to server-side tracking, trying to rebuild the trail Apple had thinned out. The fix was not a better slogan, it was infrastructure. And when an entire profession quietly re-engineers how it works, something underneath has shifted. But Apple was only one side of the squeeze. While Meta was struggling to see clearly, something else was pulling its users away. For most of its life, Facebook had owned attention. Billions of people opening the app out of habit, scrolling for hours. That attention had always felt permanent. Then came TikTok. TikTok was a different idea of what a feed could be. You did not need friends, you did not need a network. You opened it, and an algorithm simply started feeding you video after video, learning what held your eyes and getting frighteningly good at it. It was vertical, it was fast, it was entertainment first. And it was extremely strong, with younger users, exactly the audience every advertiser wanted and every platform feared losing. So look at Meta's position. On one side, Apple had weakened its ability to measure. On the other, TikTok was attacking the thing the whole machine ran on. Attention. Apple weakened the signal, TikTok captured the eyes. Meta had to respond fast. Its answer was Reels. Short, vertical, algorithm-driven video built into Instagram and Facebook, designed to keep people from drifting over to TikTok. As a defense, it worked. People watched, Reels grew quickly, but it came with a hidden cost. Early on, Reels did not make money the way the older parts of the app did. Feed and Stories had years of refinement behind them. They monetized efficiently. Reels was growing fast, but it earned less per minute of attention than the surfaces it was replacing. So Meta was caught in an uncomfortable trade. To defend attention, it had to push people toward a format that, for now, paid less. Apple had made the present harder to measure. TikTok had made attention more expensive to hold. And in the middle of all this, Mark Zuckerberg made a decision that looked to almost everyone completely insane. He decided to spend tens of billions of dollars building a virtual world. This is the part everyone thinks they understand. The headsets, the avatars, the empty virtual offices, the legs that did not work in demos. To the public, it looked like a billionaire chasing a science fiction daydream, while his real business was under attack. And on the surface, that reaction was fair. The metaverse looked awkward. The spending was enormous. The timing seemed bizarre. But underneath that awkward image was a much older fear. And once you see it, the bet starts to make a different kind of sense. Meta's apps lived on devices it did not build. They ran on operating systems it did not control. They were downloaded from app stores it did not own. The rules of tracking, of privacy, of distribution, all of it was written by two other companies, Apple and Google. App tracking transparency had just shown, in real money, what it meant to live on someone else's platform. One company, with one update, could reach down and reshape the economics of Meta's core business. And Zuckerberg had seen this before. Facebook had been born on the web. Then the world moved to smartphones. Facebook survived, even thrived. But it never owned the new platform. Apple and Google owned the phones, the operating systems, the stores. Facebook became a giant tenant on land that belonged to someone else. So when you hear Zuckerberg talk about the metaverse, and later about augmented reality glasses as the next major computing platform, listen carefully. Strategically, it can be understood as an attempt to make sure that the next time the world changed shape, Meta would not be a tenant again. It would own the ground. The headset, in this reading, was not just a product. It was an attempted escape hatch from platform dependence. This does not mean the metaverse was a good product. It does not mean the timing was right. The execution looked clumsy, the losses were staggering, and consumers did not come rushing in. But the fear behind it was rational. Zuckerberg had already watched one platform shift happen underneath Facebook, without Facebook owning the ground, and he was spending enormous sums trying not to let it happen again. The problem was timing. He was paying to escape the trap at the exact moment the trap was tightening. And soon, all of it, the weakened signal, the attention war, the staggering bets on a distant future, would arrive in one place, on one day, in front of the entire market. It was the evening of February 2nd, 2022. Meta released its results for the final quarter of 2021. On paper, this was supposed to be one of the most powerful companies in the world. But as executives spoke on the earnings call, Wall Street did not hear one problem. It heard several, and they were all in the same report. The first crack was something that had never happened before. For years, Facebook's user growth had looked unstoppable. This time, Facebook reported a small decline in daily active users. The drop was tiny in raw numbers, but the symbolism was enormous. The machine that always grew had, for the first time, slipped backward. Then came Apple. Meta spelled out, in its own words, that app tracking transparency was hurting its ability to target and measure ads, and that the headwind for the year ahead was on the order of $10 billion. Then came TikTok. Zuckerberg pointed to competition for people's time, especially from apps like TikTok. The company's answer, Reels, was still earning less than the feed it was pulling people away from. And underneath all of it sat Reality Labs, quietly burning through billions on a future nobody in the market could yet see. Any one of these on its own, the market could have absorbed. But together they told a single frightening story. The present money machine was slowing and harder to measure. The attention it ran on was under attack. And the company was spending a fortune chasing a future that might be years away, if it arrived at all. That was the night the narrative broke. The next morning, the Meta logo sat next to a red line falling off a cliff. More than $230 billion in value, gone in a single trading day. The crash was not random. It was the market finally seeing the whole system of risk at once, after years of looking only at the friendly blue app on the surface. So why did everyone blame the metaverse? Because the metaverse was the part you could see. Attribution loss is invisible. A weakened signal is invisible. But a billionaire spending tens of billions of dollars on cartoon avatars and virtual meeting rooms? That you can picture instantly. Reality Labs, the division building Meta's virtual and augmented reality future, lost about $10.2 billion in 2021 alone on a future most people still did not use in their daily lives. So when investors looked at that number, sitting right next to a slowing ad business and a first ever dip in users, it did not just look expensive, it looked reckless. But here is the nuance almost every version of this story misses. Reality Labs was not the root cause of the crash. The core business pressure came first. The Apple change, the TikTok threat, the measurement fog. That was the real wound. Reality Labs was the most expensive symptom, the most visible sign of a company trying to buy its way out of platform dependence at the exact moment its present looked shakiest. The headset was not the disease, it was the bill, arriving on the worst possible day. That is why the metaverse mattered, but not in the simple way people thought. It did not kill Facebook. It magnified the fear. It took an invisible problem and gave it a giant, awkward face with a $10 billion price tag. And here is where the story refuses to end the way you would expect. Meta did not die. Within roughly 2 years, the company staged one of the most dramatic recoveries in modern corporate history. The stock did not just climb back, it went on to reach new highs. But it was not the metaverse riding to the rescue. Zuckerberg called 2023 a year of efficiency. In plain terms, that meant deep cost-cutting and large rounds of layoffs across Meta's offices. The company that had been spending freely suddenly became disciplined. At the same time, it kept repairing the ad machine. The same reels that once earned less began to monetize far better as the system matured. And Meta leaned hard into artificial intelligence, building tools that helped advertisers target and optimize, even with weaker signals than before. In a strange way, the company started using AI to rebuild some of the certainty Apple's changes had weakened. None of this came from one magic solution. It was a combination. Cost discipline, a maturing video format, smarter ad tools, and a patient rebuild of the engine underneath. Meta recovered by repairing the machine. Not because the world finally fell in love with the metaverse. The virtual worlds had still not become mainstream. Reality Labs was still losing billions. The recovery came from fixing the present, not from winning the future. Which means the recovery does not prove the metaverse was right. The thing that exposed Meta's weakness and the thing that saved it were both about the ad machine, not the headset. So let's step all the way back and look at what this story was really about. For a few years, the easy version won. The metaverse killed Facebook. A billionaire lost his mind in virtual reality. It was a clean, satisfying story, but it was the wrong villain. The real turning point was never a headset. It was a small privacy prompt on an iPhone. A single question answered by millions of people that quietly revealed the weakness inside one of the most profitable machines ever built. Because here is the uncomfortable truth at the center of it all. Meta had constructed an empire on ground it did not own. Its apps lived on Apple's phones and Google's operating systems. Its reach depended on their app stores. Its entire advertising engine ran on signals that flowed through platforms controlled by other companies. For years, that did not feel like a risk. It felt like the way the world worked. And then Apple changed one rule, and the whole structure trembled. That is the lesson that outlasts the crash. The company that owns the platform gets to write the rules. Everyone else builds on borrowed land. And once you see it here, you start seeing it everywhere. Every business built on top of someone else's app store. Every creator who depends on one algorithm. Every company that mistakes scale for control. They are all standing on ground that belongs to someone else. So the metaverse did not crash Meta. The fear behind the metaverse did. The fear of being a tenant forever. The fear of waking up one morning to find that the landlord had changed the locks. Meta survived. It adapted, it rebuilt. But it never fully escaped the thing that scared it. Because somewhere out there, the next platform shift is already coming. And the only question that really matters is the oldest one in this entire story. When the ground moves again, who will own it?